All right. Well, thanks everybody for joining me today. My name is Dormeier. I'm the Chief Technical Analyst at Kingsview Partners. Thank you for joining our call today. Today we're going to discuss the markets with respect to the upcoming election. If you're concerned, you're not the only one. My data looking back between now and the elections shows that investors are pricing in more risk and volatility than at any time since this data became available back in 2004, and by a significant margin as well. Well, this is quite understandable. Not only are we in an election cycle, which is in itself historically volatile, this time we have candidates holding nearly polar opposite policies, two political parties more divisive than at any time during our lifetimes. We have rioting, violence, and chaos erupting throughout many of our good cities, all with the backdrop of a global pandemic. Today, we will not be discussing policies or politics, the impact of a favorable Republican, Democrat, or a split outcomes. Rather, what we shall discuss is the market and how these uncertainties may play out until the election has been decided. If you have any questions during this discussion, feel free to ask in this Zoom's chat section, and I will try to pick up some of that either throughout this presentation or perhaps at the end. Now, we're talking about the president's cycle. The presidential cycle is the most powerful of all cycles. It is either 4 or 8 years in length, depending upon if the incumbent wins or loses, or their time just runs up. However, there are many stages within the presidential cycle. Presidential cycle begins with the new president, which is presently our current situation. The first 2 years are typically neutral in nature. During the first couple of years of a new president's administration, the president typically downplays his inherited economy, and he points out all the cleaning up he needs to do from his predecessor's errors. It is the third year, which is the most prominent and bullish, which of course played out textbook last year. This is the president putting the lipstick on the pig, making things appear nice, shiny, and bright. This continues up until the fourth year, with the president generally avoiding public policy that may hurt the economy, or just the perception of unpopular policies which may weigh on the public sentiments. Meanwhile, he's going to be declaring victory on the administration's accomplishments. Now, this past week, September 3rd, which is generally right around Labor Day, that's when the presidential cycle flips, turning from bullish to bearish. And this is simply the public becoming wary of the uncertainties that the future policies changes may bring. Bearish doesn't mean sell everything. Rather, it's just a tendency for the market to work against itself, against its own uneasiness, which is the uncertainty of policy and the possible change that changing leadership may bring. Thus, it's bearish in nature, but it does not mean like to sell everything or go hide in the sand. Neither does when the presidential side is bullish does it mean to go ahead and buy in everything. It's just simply a tendency for people to get nervous. And as I pointed out in my opening comments, this time around, if all holds true, the conditions, the sentiments are much greater than normal. than a normal presidential cycle. That's due to all those things that we mentioned above, particularly with the pandemic. So let's get into it, and let's look at what the market is telling us. So I'm going to flip on my first chart here. Okay. In our former series, we talked about the final countdown, and we discussed the ascending triangle pattern developing with the S&P. Okay, see the triangle here? Here's the top. Here's the ascending trend line. Okay. Okay, the first thing I'd like to point out here is the line up top. This was the major resistance. Okay. This is horizontal resistance. It's represented by this straight line that I've drawn on top of the chart. Okay, think of this pattern, this ascending triangle pattern, as a war between bulls and bears. Now, on the top here, we have this major major resistance line. It represents supply. And think of this as the bears are trenched in, okay? They're trenched in this resistance line, just like troops are trenched in along battle lines. Now, resistance is here because this was formerly the top of the market, where so many investors have regrets. And that regret is, oh, my account was worth X at one point. I should have sold then, and if ever I get my second chance, I'm not going to miss it again. And so as the market advances towards those previous highs, selling pressure comes in and keeps the market from violating the top here. Now the second line I have forms the other end of the triangle here. This is the blue vertical trend line is the bulls, and it's represents demand. Okay, imagine this as the bullish troops marching on towards the supply line to eventually meet this resistance. Now notice as we get closer and closer to this apex of this triangle, the bulls get closer and closer to the supply line. The range becomes much tighter, okay? And this is because as they advance, there's more and more selling pressure put on, limiting the magnitude of the advance. Okay, this pattern again is known as an ascending triangle, and it's typically resolved bullishly with a pop once we break through that resistance. And then that is exactly what we saw on Monday, March 24th, when we broke through the resistance line and the market popped. Okay, that again is a bullish apex breakout of the S&P 500. Now, if you read my market letters, you know that there was something missing. Okay, and that's what we're going to point out now. So notice here the volume. When we get this pop, this pattern calls for a high breakout, on a high volume breakout, meaning lots of people participating on the price pop. We got the price pop. The market took off right after that, and then for another couple of weeks, but there was not volume present here. This green line, this green bar should have popped through the red line and should look something like one of these green bars over here, but it doesn't. Okay, so what that tells us is that there wasn't a lot of participation in the breakout. Okay, and that is critical in any breakout, but it's especially important in any sort of triangle formation, like this ascending triangle. Okay, now not only did we not get the pop from capital flows once the price broke out happened, another thing was missing as well. We've been discussing how important capital flows are even before the market began its rocket-style recovery. Over the past few months, the capital flows, and this is what we're talking about right here, the capital flows, okay? Notice how it's also making an ascending triangle too, but notice it did not break through the resistance. It maintained below this corresponding resistance point. Okay. Now remember how this indicator once served us so well with tidings of hope when the market was going down. Now, by not breaking through and lagging the price as opposed to leading it like it has before, is now acting as a warning sign of caution. So now that we've discussed capital flows and volume, let's move to the next set of charts. Okay. So in here, we again can see here we have the S&P and the triangle. This is not on the weekly basis, but I moved this down into a daily basis. Okay. Here we have the three leading indicators that we've been looking at in the volume analysis weekly. Okay, so first notice on the top panel here, this is the number of stocks that are making new highs. Okay, and notice that it is trending slightly higher, but it remains below the trend line. Okay, then next go to the advanced decline line. Again, another indicator like our capital flows that once looked so bullish and leading the market higher, and even until just recently continued to lead the market. But notice now it's not trending higher, but it was flattening even while the market was still moving higher. And then finally, we're looking at the percentage of stocks that they're trading above or below trend. Okay, and now notice that this isn't trending higher, but it's actually trending down. Now, if you take all three of these, the commonality between all these leading indicators is that none are making new highs like the market did. So our leading indicators are mostly not confirming the bullish breakout. That stated, most are not diverging from the price trend yet either. So let's move to the next chart showing some market sentiments. Okay, now this chart is called the put-call ratio, which shows the percentage of market participants making bullish bets through the purchasing of call options versus bearish bets through puts. Okay. Now notice here back here in March, a high reading shows when people are buying more puts than calls. This is showing that the market is overly pessimistic. Okay. And when it's low, like it is now, the market is overly optimistic. Okay, so last week, this put-call ratio made an extreme low of 0.5%. That means that for every for every one put that was purchased, two calls were purchased. So only one put for every two calls. Okay, and so when this gets low, it's a short-term indication of bearishness because the market became too optimistic. Okay, now let's move forward to my final chart. Okay, and this is the of the VIX. Okay, which is the volatility of the stock market. Okay, so here we have the S&P. Okay, and now what I'm showing here in the bottom is a correlation coefficient. So when the market normally is up, the VIX would typically go down, and when the market is down, the VIX is normally up. So this means that the market and the volatility, the VIX, is inversely correlated, and that shows up here in our coefficient. Okay, so notice that down here at the very bottom, that most of the time is down here towards -1 on the bottom of our chart here. meaning that whichever direction the market goes, the VIX does the opposite. Now, sometimes the coefficient goes to 0, like as it gets up close to here. This means that the market is not correlated, okay? Now, however, there's been some extreme times, like these points here, where we get up to or very close to 1, okay? And it is during this rare time when the VIX and the market are positively correlated. Now, notice those few historical points where I just pointed out here, okay? Okay, normally that when this happens, it does not resolve itself very well, at least short term. And that's what we've been seeing playing out today and a couple days last week. So finally, the presidential cycle turned from bullish to bearish on September 3rd, where it will remain until the election is settled. Now, at this stage of the election cycle, it reflects the uncertainty of future policy. Now, if there is one thing the market hates, it's uncertainty. And this time, it's unique within our election cycle that the uncertainty is heightened by the pandemic and by these other issues. Overall, the market is still trending higher. It is normally not wise to try to fight the trend or the tape. However, the lack of confirmation from our leading indicators, the overly optimistic sentiments in the put-call ratio, and then in the VIX rate readings should suggest to us that we should be careful and strategic in deploying new capital into equities. And those invested should be utilizing a cautious approach that employs risk management. In our investment programs, some of you are invested in the dividend tree, which invests in stocks with really strong free cash flow, rapid dividend growth, and strong capital flows. The idea here is that in retirement, one requires a growing income stream. And if you live off the fruit of the dividend tree, then we're not going to be forced into selling during inopportune times. With many dividend stocks cutting or eliminating dividends due to the pandemic, the dividend tree thus far has not owned a single stock position which has cut its dividend throughout the crisis. Now, although the market is bifurcated between the e-commerce stocks, which are performing, which up until the last week have been performing fantastic, and the traditional economy stocks, which are often these dividend stocks, not performing nearly as well. However, because of the capital flow or the volume tools employed within our dividend tree strategy, the dividend tree portfolio has outperformed the U.S. Select Dividend Index by over double digits so far this year, and it's beating the S&P equally weighted index as well. Now, for our growth investors, the volume factor. The volume factors are single factor which just follows the flows of capital. It's our top performing strategy so far this year. But defensively, it employs a trailing stop loss, which allows the portfolio to raise cash when the capital flows are flowing elsewhere. And finally, we have the bull run bear high, okay? That's built for a changing market dynamic, just like we're seeing now. Here we utilize the tools that we talk about and identify in the volume analysis weekly piece. When the market's going up and our indicators are confirming it, we're going to run with the bulls. However, when the market breaks down and the indicators are confirming that, we then hide out in cash. This is a trend following system with a unique caveat, and that is that when the market appears to be bottoming as identified by our leading indicators, then we go in and buy the dip. Recently, I've written a white paper on this strategy, and if you'd like a complimentary copy, please email me. As of now, the trend's still up, and we have not taken any positions off of our bull run bear high. but we're prepared to do so as soon as our leading indicators trigger. So I'm not seeing any questions in our Q&A. I'll stick around for a few minutes, but everyone's welcome to leave. And I appreciate your participation with us today, and wishing you the very best. Thanks for joining our call. Okay, Gary has asked about the NASDAQ. So I'm going to pull up the QQQs. Okay. Notice now this, first of all, we notice the tremendous run that the Qs have had. Okay. Then a blow off here, blow off top, right at right before, I believe that was probably on the 2nd. Let's see, forget the date. Yep, right on the 2nd of September. Okay. Then we had confirmation of this volume here, of high volume sell-off. Okay, and we've pulled right down, right today, right at our support line. So this is our red line, which is right at support. Okay, again on high volume, and we closed on the low. So short term, this is not resolving itself well. Okay, we're going to have some support in here, which is just a little bit lower than where we're at right now, right around 263 on the Q. If we look at it a little bit longer term, okay, you can see that we have lots of room for our stop losses way down here, which the red and the orange line. Okay, what we need to do is we need to hold this line right here, right around 264 to to maintain the positive direction of the breakout. So, Gary's asking about the NASDAQ itself. So in the NASDAQ itself, with this chart, I'm looking at the volume, and when I pull up my NASDAQ chart, because the volume data is not very good, I don't use that. So I'm using the QQQs as a substitute for the NASDAQ. All right. Thanks for joining.